Hi everyone, welcome to Vantage Educational Series for today. So for today, we will be covering on understanding trends in technical analysis. So this would be a follow-up of the previous session that we have covered, right? So that it's basically on more on trends in technical analysis. So this is part 2 of that session that was done last week. So if you guys do want a view of the recording, you can actually take a look at Vantage YouTube webinars playlist, right? So over there, we have a recording of all the previous sessions, including the calls that were made in our live analysis session, as well as the educational series. At the same time, right, for those of you guys who are here with us today, if you guys have any questions halfway through the session, right, feel free to put them under the questions chat. So I have the questions tab open as well. So if you guys have any questions with regards to what we have covered thus far, right, do put them under the questions chat and we will take a look at them. So let's give it about maybe 1 more minute and we will get the session started. Okay, so let's start, right? So for today, we are doing mainly on understanding trends in technical analysis, right? Just a quick introduction of myself. I'm Lee Sing, so I provide FX advisory to institutional clients. I'm also part of the team that's recognized by the Technical Analyst Awards as finalists for the best FX research. So if you guys are watching a recording of this and you have any questions along the way, right, please feel free to reach out to me on LinkedIn. If you are with us live, please put your questions under the questions chat and we will get to them. So just a quick disclaimer before we get the session started. The information presented here is for educational purposes only, and it's not to be treated as investment advice. So just a quick summary of what we have covered in the earlier session, right? So this was covered last Thursday. So this is basically part 1 of the session that we have covered. So essentially last week, we covered mainly on the basics of trends, as well as how we identify them based on market structures. So in general, when prices are forming higher lows and higher highs, it's in an uptrend, and a lower low and lower high market structure is in a downtrend. Whereas if you have clear support resistance levels that are being respected, prices are ranging sideways. So later on through this session as well, I will be showing you guys a quick summary of the pictures that we have, right, in terms of how we identify uptrend, downtrend, as well as ranges. And the second part of the session, we actually covered on the fractal nature of markets. So the idea behind this is essentially prices act similarly across different time frames. So something that you observe on the smaller time frame, for example, on the one hour time frame, you can actually observe it on an even smaller time frame. So for example, the same patterns are being observed on the 5 minutes, the 1 minute, right? So that's the idea behind the fractal nature of markets. So this is also the concept as to why we identify higher levels on the higher or bigger time frame and use these levels, and then we will go down to the smaller time frame in order to find our entries, stop losses, and take profit targets. And then finally, right, in last week's session, we covered on the 3 common methods that we use in order to determine trend. So the first one, it's on market structure. The second one, it's on moving average. So essentially, moving average is an indicator. So you're able to track the the average of the price, right, across a certain specified period. And then finally, we also covered on channels. So this is a brief summary of last week's session, right? So for today, this is our agenda for today. So essentially, we will be covering in deeper details in terms of uptrend, downtrend, and ranging markets. At the same time, right, we will also be covering on support resistance zones. So how we identify them and what exactly do they represent. And then finally, we also cover on trend lines as well as applications. We will also be going through a few chart examples on them as well. So along the way, right, if you guys have any questions with regards to what's being covered in the session over here, right, please put your questions under the questions chat and we will take a look at them together. Okay, so first let's start with an uptrend, downtrend, and ranges. So I'm sure most of you guys have heard of this phrase, the trend is your friend, trade in the direction of the trend, right? So as much as possible, we want to go with the trend. So in this case, right, what exactly is the trend? The trend itself just means that this is a general direction in which the market moves. So if you load any chart, for example, right, understand that if you see that the general direction is that prices are trending upwards, trending higher, in this case, this represents an uptrend. In a downtrend, it's the other way, whereas you can see that prices are pushing lower. So in general, you should see that there should be an overall dip, right? So if you choose a starting point on any chart on the chart, and then the ending point, you should see that the starting point should be holding higher than the ending point. Now, in a range itself, range is the opposite. Essentially, you don't have a clear direction. So this is what we mean by ranges. So the idea is that prices are moving sideways. You have two horizontal lines where prices came in respective regions and essentially whipsawed on these levels, these zones itself, but you don't see clearer higher highs or higher lows that are being formed. So this is the general concept behind uptrend, downtrend, and ranges, right? So the next thing that we want to cover would actually be looking at the examples. So as we have covered just now, right? So in an uptrend, you have successive higher highs and higher lows being formed. So specifically in this example, you can see over here, right? The highs are marked out in blue, the lows are marked out in gray. And what we see in an uptrend is that the highs itself are constantly being violated, whereas the lows itself would hold. So what this also means is that if we expect, so the assumption is that the trend would always continue until there is a reversal that's being seen. So if there are no reversals that are being seen, the assumption on the higher time frame is that the trend would continue on the upside, and any retracement or any pullback within the leg itself over here could represent buying opportunities. So that's the idea here, right? So this is important. Again, I want to emphasize that because we want to trade in the direction of the trend, the general assumption is that the trend would continue. So in an uptrend, right, especially if you take a look at it on the higher time frame, so for example, on your daily, your 4 hours, in an uptrend, the trend is likely to continue. Any pullback itself within the support area, it's likely to present a buy opportunity in order to continue the upside. Of course, when price enters into this region, right, because one thing that we do need to note is that within the leg itself, price can actually come into any support region that we have within the last leg, right? So how would we know which is the support area or the demand area that we have, right? So in order to understand that, we need to go down to the smaller time frame and essentially identify this change in trend on the smaller time frame in order to continue the upside. So this is the concept with uptrend, right? So the idea is that understand that any pullback within the leg itself, especially if the higher time frame has a directional bias, any pullback within the leg itself, it's likely to present buying opportunities to play more to the upside. Okay, so this is an example of what we have, right? So you saw this example in theory in terms of line chart. Now on the right itself, we have this example that it's given in candles. So this is actually an actual chart that was taken off TradingView. So essentially you can see over here, the first thing we want to identify is market structure. So again, I cannot emphasize this enough, right? Market structure itself would give us the directional bias. You can see here in this case, right? This is the clear market structure, higher highs and higher lows that are being formed. One thing that you want to take note of as well is that take a look at this highs that are being marked out in blue and then again in gray. You can see that within this leg, right, once price push up itself, anything here that we have, which is this pullback, let me just put it in the different color, this pullback. So this in red over here, right? In an uptrend where when there is a break of structure, essentially the break of the previous high, once price breaks above it, any pullback itself would just represent buying opportunities. Essentially, price comes in, mitigate into this support region or demand area, right? And then it just continues to the upside. You see the same things again being applied over here. And this itself, right, when you combine trend line as well as the different types of support and resistance levels, which we will be covering in deeper details in the session itself, you can see actually how price can actually correspond to, or rather how you can actually use trend lines as well as support resistance areas to find your entries. So this is an example of how an uptrend looks like. Now let's take a look at a downtrend. Right, so downtrend, it's the opposite. Essentially, you have successive lower lows and lower highs being formed. Take a look at the example on the left. You can see over here, right, in this case itself, the highs are marked out in blue and the lows in gray. So in a downtrend, again, the assumption, oops, let me just go back here. So again, the assumption is that the trend would continue unless there is a change in structure. So what this means is that any pullback itself here, we can assume that when price comes into a resistance area here, we are just expecting a pullback into this zone before it continued to the downside. We can also target the low as the higher time frames take profit target. So in the downtrend itself, you can see in this region, again, right, what we have over here is that the highs are constantly forming lower highs, whereas the lows itself are constantly being violated. So you can see that the lows are constantly being broken, whereas the highs itself would hold. Take a look at the example on the right. You can see that this is an example of a downtrend. This is actually taken of a chart on TradingView again. You can see clear lower lows and lower highs that are being formed. What you do notice over here is that you can see that the highs constantly held in this region, whereas the lows are the ones that are constantly being broken. So the same thing, right, in terms of how we can use this in our trading, it's first to identify the directional bias. In a downtrend, you see lower lows and lower highs being formed. Understand that any pullback within the leg itself is basically for price to enter into a supply region that we have over here, right? So the support resistance areas, if you want to use that concept, or it can be supply demand zones, essentially for price to enter into this region, test it, and then you should see this reversal picture, right? So based on the fractal nature of market, essentially you can see that on this smaller time frame. So if this whole thing is on the 4 hours time frame, if you go down to the smaller time frame, right, once price reaches into this resistance area, go down to, for example, the 30 minutes time frame, the M30, right? So what you should see here coming into this region, it's a reversal on the 30 minutes time frame first before we see this big drop on the 4 hours. So this is the concept of fractal nature of markets. Essentially, the idea is that whatever that you're seeing on the higher picture, you would see the reversal first happen on the smaller picture. So trends are able to act similarly across the different time frames. So this is understanding the fractal nature of markets as well as using it to combine with market structure. So the other one that we want to cover would be on ranging markets. So as we have covered thus far, right, ranging market prices move sideways. You have support resistance levels that are being respected. So this is an example of how it looks like. Essentially, it moves in a range. And you can see again, this is a clear example of what we have taken off the chart. So clear support resistance levels that are being identified and being respected here. You can see, unlike in an uptrend and downtrend, where you have clear lower lows and lower highs being formed over here, right? So this is an uptrend, this is a downtrend. You see very clear market structure. You don't see that in a range. In a range, you can see that prices fail to break the resistance level and yet fail to break the support. So one particular move, or rather strategy, that is popular within ranges, it's a breakout strategy, essentially to wait for price to break above or below this range before playing the move. So essentially, if prices are moving sideways, what you want to wait for is a clear break below this level, ideally a close below this, right? So looking at candlestick patterns itself, you want a bearish big movement and a bearish candle that closes below it, representing that there are a lot of sellers coming into the market to push prices lower, and then a pullback retest, right? So this would be a breakout retest strategy to take the shots. Of course, just taking a look at the chart on this case itself, right? This is not enough, right? You want to take a look at the higher time frames direction, and again, go down to the smaller time frame to try and find these entries. So for the ranging market that we have over here, right, what is more important is to wait for a break above or below this range. That's one. So that would be the breakout strategy. The other would be straddle. So essentially selling at resistance levels and then buying at support levels. So that's two ways you can take a look at this range. But ideally, right, if we want to trade in the direction of the trend, what would be good is to wait for a clear break above and below so that we're able to determine the direction there. So this is on ranges. And then next we want to cover on support and resistance zones. So support resistance levels, right, or in general, right, these areas that we have, right, we hear them often in technical analysis. Essentially, the idea is to identify the zones that prices react to the most. So if you load any chart, right, think of it this way. If you load any chart, right, identify these areas where price seem to react and respect multiple times. So if you come into any areas over here, right, so let's say if price comes into this region, you see the bounce once and then failed here. What you show over here is that in this area alone, right, there is a consolidation of prices, right? So every time price enters into this region, what seems to happen is that you have buyers, sellers coming into the market, which cause price to be respected, right? You can see buyers essentially coming in to push prices much higher over here. And then you can see that when price push much higher, eventually you ran out of buyers to support the upward movement in price. It broke below, and then you have sellers entering the market to push price lower. So the idea behind support and resistance levels is really just identifying these zones on your higher time frame and understand that if we want to see a reversal of these zones, this reversal would have to first be reflected on the smaller time frame. So what I mean by this is that assume if you have a 4 hours time frame that you have over here, right? So if you have a 4 hours resistance that prices are pushing into, and then what you're seeing over here is that you're calling a move down, right? A bearish push down. What you want to see is that before this 4 hours break below or react to this resistance area that we have on the 4 hours. On the 30 minutes time frame or even the 15 minutes time frame coming into this region, you should see that there is this change in structure. So just zooming into this, you can see higher low, higher highs being formed, and then a clear break below the last structure before it changes to the downside. And this whole move itself would then represent the drop on the 4 hours. So you can see in terms of the fractal nature of markets, right? You do see this trend itself on the smaller time frame, for example, the 30 minutes time frame first, before we actually see the bigger reversal on the 4 hours. So this is an extremely useful concept in terms of helping you to narrow down, right, in the zones that you have selected, and also see if there are actually any smaller time frame reversal, so that we can take higher probability setups. So as we've covered on resistance, right? So resistance itself, it just means rising prices, and you have this strong rejection over here, right? So prices are pushing up, and then coming into this region, you have basically sellers entering the market, and you see this sellers overpowering buyers to push price much lower. So how we determine resistance is looking at significant swing points. So this area itself, right? So if we see slight retracement, this would be very weak resistance levels. Ideally, what we want to see over here is to see a strong push up and then a sharp rejection of these areas. So these are key resistance levels or key resistance zones, right? So they're not specific levels, but rather just an area that we want to watch. So as we've mentioned on resistance, right, essentially you have sellers that are actually overpowering the buyers. So they push prices lower, right? So they're taking control of the market. For support, it's the other way. Usually you see strong falling prices coming into this region, and then coming into an area, you have this sharp significant move up where buyers came in, push prices much higher. So this sharp reversals itself, right, ideally if they're accompanied by heavy volume, right, this is a good sign. So essentially what this means is that in this case, you have basically bigger players entering the market. So it works for both resistance and support levels. So the idea behind this is that when price comes into this region itself, right, if you have huge selling volume over here, it shows that you have big sellers entering into the market, right, larger players to push prices lower, and likewise the same thing with support. So volume, right, depending on the brokerage itself, if you take a look at TradingView, I believe FXCM as well as Pepperstone, these are ones that you can take a look at the volume with regards to price, right, across a certain range or time period. Whereas for some brokers itself, like for example, other brokers, you might not be able to see that, right? So you just take a look at the providers that are offered there, and you can see whether this can actually be seen on TradingView. So these are examples of how you can look at support resistance zones. Now let's take a look at what we have in the next slide. So let me just clear the drawings, right? And again, if you guys have any questions so far coming into the session, right, please put your questions under the questions chat, right? I hope it's clear, right? So this is actually a very useful concept that you can use in terms of identifying your trades. So yeah, so it'll be good if you're able to get these concepts, right? If not, if you guys have any questions, right, do feel free to put them under the questions chat. So I identified, or rather I talk about support resistance levels quite a bit in the previous slide, right? So in this case, I want to cover exactly what are the different types of support levels that we can look at, right? So mainly they're broken down into three types, right? So the first one, that's actually more of this support level where we have essentially, this is what we call this swing low, right? So essentially price came into this region, you saw that push up, and then price tested the area, bounced off multiple times. What this also represents is that there are buyers coming into the region itself. So every time price reaches this level, right, you can see that there are sellers who are basically exhausted. You don't have sellers coming in to push price much lower, whereas you have buyers entering the market. So this is the first kind of support level that we have. The second kind of support level that we have, it's a resistance turn support area. So again, right, looking at this region itself, you can see that you have sellers again coming into the region twice, but fail to push prices lower, and then price just rallied higher to the upside. And what is also interesting to take note of in this case is that usually, right, what we have here in terms of the market structure, you can see that the second leg, so essentially this leg that we have over here, when price push much lower, usually what it shows is that it fails to break past the previous low. So if you take a look at the drawing that we have over here, right, you can see that in this case, right, on this second reversal over here, right, if prices were to continue in a bearish move, it should be continuing to form your lower lows and lower highs. But what you can see over here is that usually price fail to break, right? So it respects this support level, it fails to break the previous low, and then it continues on the upside. So this is actually a clue, right? So recall that when we say there's an assumption, so in a downtrend, it should continue to form your lower lows and lower highs. But in this case, because it doesn't, right, and it started respecting the support region, you can again go to the smaller time frame. So if you're on the 4 hours in this case, right, you can go down to the smaller time frame once price reaches this region, go to the 30 minutes and see if you have the same structure forming, right? So if prices continue to form lower lows and lower highs, coming into this support region on the 4 hours, you can see that there is this change in structure. What this tells you over here is that demand or support demand areas are now in control, and you can then target this high that we have. Okay, so that's the thought process behind it. And then finally, this is the third kind of resistance turn support level. And this resistance turn support level, it's the same thing, essentially price coming in to test it as resistance, failed to push price lower before it continued to the upside. Once price breaks above the upside, this region is then tested as support again before it continued higher. So you can see that the similarity between these two pictures, the main difference is that in this case, this has not been tested as a support, whereas in this example, this has been tested as a support. One thing I do want to highlight in terms of the psychology behind this is that understand that, for example, if prices are in a resistance area, right, essentially you have sellers coming in to sell, right? So they're holding on to sell positions. So when price push much higher, right, if they're not stopped out, if they have their stop loss just much higher above this region, what it shows over here is that they would be in a drawdown. So essentially they're holding on to their negative positions, right? So when price comes back up and test this region again, they're at break even. This is when they might close out their short positions, right? Their sells, because if you take a look at it in terms of market structure, you can see that price actually broke the high. So what this shows you is that there's a change in trend. So they will close out their sells, and also maybe some of them, it might entice buyers to come into the market, which represents this push up. Okay, so this would be on the 3 types of support levels. The next would be on the 3 types of resistance level. The idea is the same. Essentially, you can see that this is the opposite, right? Price came in, tested as a resistance twice. It's basically an area where price respect the zones over here. So this is the first type of resistance level. The second kind is when you have buyers essentially entering the market but fail to push prices much higher. You can see this bearish market structure in terms of lower lows, lower highs being formed, and then a clear break below, and this is now the resistance level. So for those of you guys who might be confused in terms of how you determine whether it's a resistance or support, right? Look at where current prices are. So identify the zone first, right? The first step is to identify that zone to see where prices interact with. The second step is to look at the current price. If current price is currently holding below this gray zone that we have, then in this case, it serves as a resistance. Think of it as a ceiling, right? So if prices are holding above, or rather if the zone is holding above price, then it's a ceiling, it's more of a resistance. If current prices are actually above the zone, right, then in this case, you can think of it as a floor. So that means this will be a support area. Okay, and then in this example, the last example that we have, again, these are support and resistance levels, essentially price holding as support, fail to push higher, and then retesting this region as a resistance. The concept is the same, right? If you have buyers coming into the market over here, they are holding onto the negative positions. So on that pullback itself, we can see that it could induce some sellers to come into the market, right? They either close out, so the buyers would close out their positions, some sellers would take shorts, so which represents this move here. Okay, and then let's take a look at the next slide. So in this example, right, we are looking more at on trend lines and applications. So in general, right, we know that in an uptrend, markets form higher lows and higher highs. Now, how do we apply this higher lows and higher highs, right? So first, we need to take a look at the troughs. So another thing about this is that just think of the troughs as the lower lows and highs here. So in this case, right, these are the higher lows and higher highs that we have, right? So in this example itself, you can see that in an uptrend, you want to connect the troughs. So essentially the lows of this move, and in a downtrend you want to connect the peaks, so these are the highs of the move itself. So in an uptrend you want to draw a diagonal line across, and this should connect the troughs, and a downtrend, a diagonal line down would connect the peak, and this areas itself, or this lines, would serve as dynamic support and resistance levels. The reason why we use the word dynamic is because prices are constantly changing, right? So when we connect the lines over here, we can see that these new levels that we have, especially if they line up with horizontal support resistance levels, they would serve as clear resistance or support levels. And then finally, we take a look at trend lines. So trend lines itself will provide a signal in terms of the change in direction. So in an uptrend, we expect price to continue higher lows and higher highs. And once there's a clear break below the trend line, it could suggest that this uptrend is no longer continuing, right? So buyers are exhausted. You don't have enough buyers to come in to push price much higher, and then we could see a reversal. Likewise, the same thing applies, right? In a downtrend, lower lows and lower highs being formed. If the downtrend lower lows are not being respected, we see a clear break above. This could signal the end of a downtrend and then a reversal from here. Next, we will also be covering on directional trend. So on directional trend itself, right? So the idea is basically trend will help us to determine the direction. So if you take a look at any charts, right, there are a few ways we can draw the trend line. So one kind that you have is essentially prices just climbing slowly over here. You can see this gradual climb, this gradual trend line that we have here, right? And the other kind is where price just went parabolic, right? So it just pushes much higher and you can see very steep trend lines coming in. So understand that the steeper the trend line, so essentially the more upward sloping or downward sloping it is, right? Which means that instead of having big pullbacks to continue on the upside, you are looking at very narrow pullbacks before price push much higher. In this example itself, right, this usually the steeper trend line will represent a stronger trend. So the idea is that you have a lot of buyers coming in to push prices much higher. You have strong bullish momentum or strong bearish momentum, right, in a downtrend. But in this case, it's less sustainable because you will come to a point where you have essentially no more buyers to push price much higher. So this is the reason why, right, the steeper the trend lines, the less sustainable it is, and eventually we could see that trend reversal. One more thing we do want to understand as well is that you can combine trend lines with support resistance levels. So in this case, right, when you have trend lines giving you a clear direction of the trend, and also support resistance levels, where this regions where price comes in to test these levels, then this gives us a higher probability setup. In terms of exactly how we use this concept, we will take a look at it in terms of the chart examples. So let's take a look at the next slide. Okay, so this is an example of a trend line. So in this case over here, right, first thing we want to identify the general direction of the trend. So in the general direction of the trend, you can see that we have bearish move down, right, lower lows and lower highs being formed. So that's the first step, identify the general direction of the trend. You can see lower lows and lower highs being formed. You can see this, right, the highs are marked out over here. And what we have, right, is that the next thing we want to do is that having identified it's a downtrend, in a downtrend, we want to connect the peaks. Understand that there's no reason for us to connect the troughs. So you can draw a trend line that's like that, right? But it doesn't matter because in a downtrend, we expect the lows to be broken. So essentially, right, what we want to take note of is that the highs itself should hold in a downtrend. So as long as price forms a new high and breaks below the previous low, we are not expecting price to break above, because once price breaks above this region, what it signals is that there's a potential change in trend, because the assumption is that the downtrend will continue to hold and form lower lows and lower highs until there is a change in trend, which is the break of the last high that we have here. Okay, so in a downtrend, it's important that we connect the highs because these are the highs that we are assuming that price would hold and would not break the region. Once price breaks above the region, that is when we want to consider that there's a change in direction of the trend. So take a look at this, right? All the highs being marked over here, they're not broken. You can see this high being formed over here. And in this example, this is a perfect example of how you can combine resistance levels as well as trend lines. Take a look at what we have over here. So recall we said we want significant rejection. So if you take a look at the small rejections here, you can see that these are very insignificant. How so? If I were to trace out these moves, you can see they're extremely small moves, whereas pushing up over here, you can see this sharp V reversal, right? So almost representing like a mountain top. And then if I were to stretch this horizontal line across, so let me just draw this, right? You can see that stretch this horizontal line across. You can see that this is a resistance area, and this is the first type of resistance level that we have covered, right? So we recall that we covered three types of resistance level. This is the first kind, and the second kind is support turn resistance level, and the last kind, it's basically support and then tested as a resistance. So this is the first kind of resistance, and you see this over here, the sharp reversal, and then also in line with the trend line. So this reversal over here, right, in line with the trend line, and more importantly, it actually covers this horizontal resistance that we have. So one thing about trend line is that it tends to be very subjective. So as much as possible, try to identify the horizontal levels first, and then the trend line should be more of a complement. So take a look at this example again, same thing. You can see a clear break of structure over here, the clear break of the previous low. So the understanding is that this high itself that took out the low over here, this high itself should hold, right? So we're not expecting price to break above the high unless there's a change in trend. And you can see that this became a clear support turn resistance level here. So again, if I were to draw a horizontal line across, you can see here, price came in, tested as a support, and then failed as a resistance. And you can see that again, this is the third type of resistance level. one where price came in to test as support and then failed as a resistance to push lower. This is exactly what you're seeing over here, right? So this is exactly how we can apply the 3 different types of support and resistance levels. So let's take a look at the next slide that we have, right? So this is on the trend line. So in this case, this example is more on the uptrend. So in an uptrend, you can see higher lows and higher highs being formed. And this is the last low that was being formed. And this low that we have over here, again, it lines up with this ascending trend line. So in this case itself, you can see that again, right? What we do want to identify on this low itself, it's again the horizontal level. So this is the first kind of support level that we have, essentially the swing low, price coming in to test this level. And then you can see that on the break below the trend line, right? What this suggests is that there's a potential change in trend. So in an uptrend, right, this uptrend is no longer being respected. We could see that reversal. Okay, so this is another example. You can see that in a downtrend, again, lower lows and lower highs being formed. And this is a clear example of this resistance turn support level that was being respected. You can see in this example here, right, lower low, lower highs being formed, and then a clear break above the last high that we have, which signals a change in trend. It's also a break above this descending trend line. And then price came in, tested this region, which was the previous resistance turn support area, tested as support, and then continue on the upside. Okay, and then another example that we have over here, right? So same thing. All these examples are basically to show the concept of combining trend lines and support resistance levels, right? So I'm identifying this resistance support levels first, and then at the same time, you can see that there is clear market structure. So higher lows and higher highs being formed on the pullback itself, and then in this region, you can see the region that's marked out in green. Essentially, this area over here where price came in, right? You can see the sharp resistance and then price coming in to test this area. And this level itself, right, lines up with the trend line and lines up with the graphical level. This was a previous resistance turn support area, and then it just continued much, much higher. So these are examples. I hope that they are clear in terms of how we can use trend lines and its applications. Of course, some of this, right, because these are examples, you see how they play out. So ideally, what we want to see coming into this region in terms of how we can apply to our current trading strategy is that look at these examples and take a look at how when price enters into this region. So understand that price might not hold fully in this region. You can see these sharp spikes below the region, and these are what we consider stop hunts. Essentially, price just tapping lower into an area of liquidity to take out any liquidity, take out stop losses over here before it continues to the upside. So this is the reason why it's important that we wait for reversal on the smaller time frame first before just taking any trade, right, once price reaches this zone. Okay, so with that, we have covered on trend lines and its application. And this is just a brief summary of what we have covered thus far, right? And if you guys have any questions as well, do put them under the questions chat. So for this, right, we have covered on how we can identify uptrend, downtrend, as well as ranging markets. We also covered on the different types of horizontal support resistance zones that we have, right? So mainly the 3 types, right? So if you guys recall, the 3 types of support level that we have would be the first kind over here. The second kind would be essentially the one that has been tested as support and then failed. And right now prices are holding as a resistance. And finally, the third kind is one that price came in to test as support and resistance. So this is for the support levels. For resistance, it's the other way. You see this mountain top like being formed, right? Essentially, significant reversals over here, which price came in and respect. Again, you see that same thing happen, right? When price came in to test as support and then price failed completely. And right now prices are currently holding below this zone that we have over here. And then finally, the last kind of resistance level, it's one where price came in to test and then it held as both a support and resistance level. So these are the 3 types of support resistance zones. And also we have covered on trend lines and applications, basically looking at examples where we can apply both trend lines as well as the different types of support and resistance levels that we have. Okay, so I hope that this session has been helpful in terms of understanding how you can actually better apply trend lines, support resistance levels, and also understanding the different types of support resistance levels. And more importantly, understanding how you can actually combine all these concepts with market structure. I cannot emphasize again and again that market structures are extremely important because they help us to determine the directional bias. So what's the higher time frame telling you, right? And then from there, we go down to the smaller time frames essentially to take this trade. Okay, so I see that we have no other questions as well. So I'll just leave this on for maybe about 1 minute or a few seconds, right? And then if you guys have any questions with regards to support resistance areas or whatever we've covered so far, or if there anything that you want me to clarify, please put them under the questions chat, right? So I do have the questions chat open. So I'll just leave them here. And if you guys have anything, right, do type them under the questions chat. So if I'm just waiting for any of the questions that you guys might have, do also check out Vantage Markets, vantagemarkets.com/webinars, right? So for this, you can cover more on the schedule, take a look at the schedule and the topics that are being covered. So for tomorrow, we are covering more on the fundamentals. We will be covering more on dollar. So there has been a lot of things going on with the dollar so far, with the Fed rate hikes and also recession risks. Dollar itself is also a safe haven, right? So those are things that we will cover in tomorrow's session. It will be more of a fundamental session, just understanding what are the main drivers for the dollar. Do we see the dollar strength continuing, or does this mark the end of the dollar rally, right? So this will be more of a discussion and also certain views that we have over here, right? So more on understanding the factors driving the dollar. So that will be for tomorrow's session at 4 p.m. right? At the same time, we'll also be taking a look at the DXY chart. Also, if there are any chart requests, right, do put them under the chat and we'll take a look at them. Okay, so any other questions as well, do put them to do send them to support@vantagemarkets.com. Okay, so for today, I hope that the trend line applications as well as the examples that were given, right, the concepts are useful. So for those of you guys who do attend our live trading session, right, you can see that these concepts are widely used in this live trading sessions as well, right? So essentially using the higher time frame, determine the trend, if there are any trend lines, but more importantly is determining market structure first, right? Is it bullish? Is it bearish? And then look at the zones that price entered. Once price entered into these areas, take a look at the smaller time frame. Go down to the smaller time frame because this use the fractal nature of markets concept, right? So essentially you see the same pattern repeating itself over and over again on the smaller time frame. Once you see that reversal on the smaller time frame, it lines up with the higher time frames picture. That's when you can either buy or sell. Okay, so I hope that this helps. And if you guys want even more detailed examples of how we can apply this trading strategy, right, we can cover that. We can actually carve it out in one of the sessions, right? So if you guys prefer that, right, you can also give us your feedback on this and we will carve it out accordingly. Okay, so I hope that this session has been helpful, right? So for those of you guys who stayed with us all the way, right, I see that all of you guys have been here with us, right? So thanks very much. And I hope that we will catch you guys again in tomorrow's session. Okay, so I see that we have no other questions as well. Thanks everyone. Stay safe, trade safe, and we will catch you guys again soon. Thank you and goodbye.